Hello and welcome to Martyn Lucas Investor. My name is Sensei and you're watching the Morning Forecast Show. Today's top story is there are record highs in the markets, record highs for AI stocks, record highs for the S&P 500. Rate cuts are now pretty much confirmed that we're going to have 3 rate cuts, at least 2 this year, and 3 out of the next 4 meetings we're expecting rate cuts. But there are 4 metrics that say that this rally cannot last. We're going to be going through them, 4 charts, 4 bits of data that show us this rally could be popping. This bubble that we are in a bubble 100% could be popping, but there could be some space to run beforehand. I'm going to tell you exactly my strategy, where I think we're going, and tell you about all those 4 metrics. So if you are watching live or later on, please do make sure you are hitting the like button, subscribe if you haven't done so before. Remember, we are always live every single morning at this time. So, what am I talking about? Well, I'm talking about the fact that everything seems to be overvalued. We've got the S&P 500 at one of the highest valuations we've ever seen. They're at all-time highs, but also valuation is different. We're looking at gold at all-time highs. We're looking at silver breaking all-time highs and about to short squeeze. So let me just talk to you about the S&P 500 first. This is a chart of the S&P 500. You might say, well, the S&P is well above where it was in 2000. What is this chart? This is the chart of the S&P 500 divided by the money in the system, how much money's been printed. So it's the S&P 500 divided by M2. This really shows how overvalued the market is, because remember, the reason the market's up right now since 2000 is because of innovation, because mainly of how much money is now in the system, how much money has been printed. But if you adjust for the amount of money that's been printed, we are now approaching the 2000 dot-com level. This 2000 level was one of the biggest bubbles we've ever seen in the stock market. It was one of the biggest moves up. It was one of the biggest overvaluations, and it led to one of the most brutal crashes ever. And we are now approaching that territory. So if we draw a line across from the peak of where we hit in 2000, I'll tell you exactly how much can be potentially left in this run based on this metric. It looks like another 7% up from here on the S&P 500, and we can be even going past those 2000 levels, which in my opinion would be a massive red flag, and we are already approaching those levels. So that's the first chart I wanted to show you, but we've got a lot more to get through. So are we near the top of the cycle? Well, let's go through the metrics. So we are in one of the rare moments where optimism and anxiety share the same chart. The S&P 500 keeps breaking records on the back of the AI boom. Yet every new high feels a little more fragile. Valuations are stretched, sentiment is euphoric, and even seasoned investors are wondering whether we are witnessing innovation or inflation in asset prices. In this deep dive, we'll unpack what the key metrics are really telling us, how today's market stacks up against past bubbles, and where the money could move next. First of all, let's look at the first metric, forward PE. This is the first metric. If you have just tuned in, please do hit the like button, subscribe if you haven't done so already. We're going to go through 4 metrics that can suggest we are in for a big crash. I've just seen a message. Okay, there we go. So what is it? We've probably heard of it. Some of you might know what it is, but just for anyone who doesn't, the forward PE, the price to earnings, simply compares what investors are paying for the stock today versus what companies are expected to earn over the next 12 months. Think of it as a price tag on each dollar of future profits. So if you're paying 20, if the P is 20, you're paying essentially $20. Oh, you're paying 20 for $1 profit. So you're definitely paying more for the profit. But simply put, it is how much you're willing to pay for the future profit of the company. And any PE over 1, you're overpaying, which obviously makes sense. So why it matters? When this ratio climbs above its historical range, it means optimism is high and the market is assuming strong earnings growth ahead. If that growth doesn't materialize, prices often adjust downwards to restore balance. So we always expect companies to grow their profits. We always expect companies to make more profits, but it depends to what degree do we expect them to do it. If it's got a PE ratio of 20, we expect them to really improve their profits. If they've got a PE range of 100, we really expect them to ramp things up. But if they don't deliver on that, then the market will bring the stock price down to adjust that PE. So where are we now? And remember, the S&P 500 has a PE of all those 505 companies in it. So the S&P 500 forward PE sits around sits around 23 times earnings. So the PE ratio on the S&P 500 is 23. Over the past decade, the average has been closer to 18 to 9 times earnings. That is where we typically sit on the S&P 500, 18 to 19 times earnings. That puts us well above the normal levels, a clear sign of elevated valuation. So the PE ratio is saying we are very overvalued. And just so you understand how overvalued the PE is saying we are, to fall back to its long-term average, so to go from 23 to back to 18, 19, while earnings stay flat, the index would need to drop about 20%. That's to go from 23 back to 18 and a half. Even if corporate earning profits rise, so if profits increase and the P ratio comes down a little bit anyway because of that, valuations will still need to cool by 10 to 15% to get back on trend. And that's more likely. More likely, these corporate profits are going to continue to rise, but they're not going to rise enough to justify the PE. So they're going to also still have to drop 15%. Or if they don't rise and we get bad earnings, then they'll have to drop by 20 to get back to the average. And remember, we can go below the average as well. We've been above the average for a while. We can go below the average for a while as well. That could result in a 30, 40% crash. So in other words, earnings now have to grow rapidly just to justify current prices. So the earnings have to really, really beat just so the prices that we are at today stay the same. Any disappointment or another tick higher in interest rates could bring a sharp valuation reset. So that is the first indicator. The forward PE ratio right now is overvalued. It's overvalued if earnings are beat. It's overvalued if earnings stay the same. The PE is suggesting a crash of between 10 to 15% if earnings continue to go up to about 20 to 30% if earnings stay flat. So the PE ratio, the first indicator, is saying we are overbought. Remember, this is not just any financial advice. I'm not saying sell your positions. Most people, if you hold long term, you go through bear markets and bull markets. This is more to understand what's going on in the macro world. Also, I'm going to give you my specific predictions as well, because I don't think all of this means a crash is coming tomorrow. It's something I want to keep an eye on. So do stay with us. Schiller cap is a cyclically adjusted price to earnings, smoothing the cycle. So what is it? The Schiller CAPI averages real inflation adjusted earnings over the past 10 years and divides it by the current price by that average. It smooths out the boom and bust swings. So why is it useful? It's less sensitive to 1 year of good or bad earnings and gives a longer perspective on valuation extremes. So this is something that smooths out the boom, smooths out the busts. What level are we at today? So the level we're at right now is a 40.0x per multiple. So what does that actually mean? That is fairly extremely overvalued, because historically the average has been 17 to 18 times. So that's a massive stretch. The last time we saw such levels were around the dot-com peak. That's why I started today's video off by talking about the dot-com era, because the sentiment we're getting as analysts in the market is that this is very similar to the dot-com era, where dot-com we had amazing new technology, which was obviously the internet. This time around, we've got amazing new technology, which is AI, and crypto and blockchain, these new technologies. So they are very similar. But the dot-com had a crash. Are we going to get a crash for this cycle as well? I think so. So the CAPI is around 40. The average normally is 18. Around a 40 is very close to the peak of the dot-com level. So markets are starting from very high CAPE levels, tend to have low long-term returns, especially over the 10 to 20-year horizons. CAPI is not a crash timer, but it warns that future is tough. The CAPI now sits around 40, just shy of its 44x record from the dot-com peak. So the highest this indicator has ever been is 44. We're at 40. To reach the same valuation as back in the dot-com, the S&P 500 only needs to climb another 10%. So that does suggest there could be another 10% rally in the S&P 500. If you look at this indicator as well, this chart as well, to go to the peak of the dot-com here, the S&P can rally another 7%. So there could be another 5 to 10% rally on the S&P 500 to hit these peak valuations on multiple indicators. So in other words, another modest leg higher would put us right back in the most expensive market in modern history. We are 5 to 10% away from the most expensive market in modern history. And I'm not talking expensive in terms of the stock price. I'm talking expensive in terms of every indicator out there, taking into account money supply, taking into account inflation, taking into account euphoria. So that indicator as well, the Shiller CAPI is also suggesting we are very, very close to historically very, very extreme valuations. We've got one more indicator, or two more indicators. The rule of 20. If you have just tuned in, we are considering if we are in a market top, if we are at the end of a market cycle, and we've got a few indicators to show you. If you have just tuned in, make sure you have hit the like button and subscribed. I'll come to everyone's questions after we go through this. So, the rule of 20, a quick fairness test. So what is the rule of 20? The rule of 20 is simply a sanity check for valuations. It says the market is fairly valued when the sum of the forward PE ratio and the annual inflation rate equals 20. If the total is above 20, stocks are expensive. If the total is below 20, they're cheap. Right now, obviously, we know our forward PE on the S&P 500, and we're just taking the S&P 500 as a benchmark here because it's probably the most famous ETF, and it probably gives us the most amount of data. The 500 biggest companies really tells us a lot about the market. So where are we at now? Right now, 23 times forward earnings. Inflation is about 2.9%. So if you add them together, we're at 25.9. So that's roughly 30% higher than the fair value benchmark. To get back down to 20, so remember 20 is sort of the base, above 20 is expensive, below 20 is cheap. It's just, again, another indicator. You can't always just take these indicators by themselves. That's why we're doing lots of indicators in today's show. So that's roughly 30% higher than the fair value benchmark. To get back down to 20, while inflation holds steady at 2.9%, the forward PE would need to fall to about 17.1x. So the forward PE needs to come down to 17x to get back to just a fair valuation, not an undervaluation. And remember, we normally go from overvaluation to undervaluation, so there could be more of a drop. But just to get to a fair valuation, that would require the stock price to come down, and that's the S&P 500 to have a 25% decline. If you want to go up undervalued, it could be a 30, 40, 45% decline as well. But just to get back to a baseline of this indicator, to get back to 20, you should be expecting a 25% decline in stock prices. If that's only if earnings don't rise. If earnings rise, then the forward PE naturally comes down. But if the stock price rises when the earnings go up, then you still got the same forward PE. So what does it mean? By this rule, the market isn't just pricey, it's well into the overvalued zone. It doesn't signal when a correction will happen, but it shows how stretched expectations have become. In plain terms, for stocks to stay here, everything has to go right. Earnings, growth, inflation, and rates. We are pricing in perfection, basically, in the markets right now. One more indicator, and then I'll give you my thoughts. Remember, if you're investing long term, it doesn't really matter. But if you're a daily investor, it's very important to keep an eye on these metrics. This is all from our newsletter. You get something like this into your inbox every single day. So make sure you have signed up to the newsletter. There's deep dives. There's the top 5 stories. There we go. Someone's saying, Stephen B saying, why are you deleting my messages? I haven't touched any messages. As you can see, I'm quite busy. I haven't been deleting any messages. I'm looking through the comments. No one's deleted your messages, Stephen B. I don't know what you're talking about. We've got a troll in the chat. Okay, and then one of the last indicators, and then I'll give you my thoughts about, are we actually in a bubble, and does that mean sell everything and panic, is the earnings yield gap versus the treasury yield. So what is it? Earning yield. So this indicator basically gives you the earnings yield. You take 1, divide it by the forward PE. It's what you earn via equity relative to what you get in bonds. You're comparing it to a very safe investment now. So what are we now? The forward PE is 23. That means the earnings yield is about 4.35%. The 10-year treasury yield is approximately 4.1%. So the premium you get for owning stocks over a risk-free bond is a small 0.25%. When the premium is thin, equities need to deliver. If interest rates go up or earnings lag, the trade gets shaky. So as you can see, this is an indicator that compares where we are in the market now, compares it to treasury yields, and says, is it worth the risk? And essentially, the premium you get for owning stocks right now, according to this indicator, is a very small 0.25% more you get in the stock market. So again, this is one of the reasons Martyn has gone into exactly T-bills and buying these treasury yields, because of the rate you can get compared to what is sort of expected to continue within the market. So this is the earnings yield. It's 1 divided by the forwards PE. It's what you can earn via equity relative to what you get in bonds. So let's put it all together and give our thoughts. Are we in a bubble? The question is, are we in a bubble? Yes, we are in a bubble. In the sense of that valuations are stretched, sentiment is exuberant, and many of the classic late cycle warning signals are present. But that doesn't mean the top is in tomorrow. That doesn't mean I'm going out and selling all my positions today, tomorrow. We are in a bubble. The signals suggest we're in a bubble. Many signals are suggesting we're at nearly the highest levels ever. Some of them are suggesting we are at very overbought conditions, but that all suggests we are in a bubble, but it doesn't mean I'm selling my positions. The metrics agree. The forward PE is high relative to history. The Schiller Cappy is in a territory seen only in extreme eras, the dot-com era. The rule of 20 signals over valuation. The yield gaps give little margin for error. Also reinforcing the bubble hypothesis, market leadership is narrow. Mega names, AI darlings, breadth is weak, and the liquidity metrics like the S&P over money supply, which is what we look at here, suggests equities have run far relative to money supply. But here's the nuance. This is what you need to be careful of. Bubbles often stretch far further than people expect. Prices can climb while cracks begin to form underneath. I believe these are the cracks. I don't like betting against a very bullish market. The market right now is very much in a euphoric period. And when it's in a euphoric period, you tend to get the biggest gains. So bubbles, historically, people call for bubbles, and then the markets go up another 20-30%. I'm not saying the S&P 500 can go up another 20-30%, but even if the S&P 500 goes up another 10%, 5-10%, which is very possible, anything over that I would be very, very, very surprised about. But it can go up another 5-10%. Just that would bring so much FOMO into the broader markets. It can push other stocks and crypto up hundreds of percent. So bubbles often stretch further than people expect. People will FOMO back into the market. Prices can climb while cracks begin to form underneath. These are the cracks. There are plenty of cracks right now in the market where money might flow before the crash, because in my opinion, we'll get money flowing before the crash. So if you accept we're in the later innings of a bubble, here are some areas money tends to go before the final pop. Smaller speculative names. Late stage mania often reaches far into microcaps, biotech, and narrative plays. So you start looking at the microcaps, the Russell, the Tilrays, the SBCEs, the EVTOLs, anything that's new emerging stocks that no one knows if they're going to stay around for a long time. Meme stocks, those speculative smaller market cap plays, normally the money goes into before a final pop. Then we start looking at our altcoins, so crypto and altcoins. If risk appetite runs high, capital often spills into these volatile arenas. So that's why I am holding my altcoin positions, because I think this final part of the bull run is when most of the money has been made. And if you think about it for just a second, this is what we've been saying for the last 3 years. This makes absolute total sense. The altcoin season, the final run of Bitcoin and actually mainly altcoins, I've always said it happens between 2 weeks and 2 months. That final euphoric period when most of the gains are made in the crypto cycle happens between 2 weeks and 2 months. That's the only period historically in bubbles. So what makes sense is that we are very overvalued in many, many markets. That money flows in to the crypto market cap and to the crypto market. The altcoins, because they're very low market cap, start going up 50, 100, 150, 200, 300, 400%. And then the bubble bursts. And that's exactly what we've been predicting. And it's so great to be in this type of market now, because everything we've said has been correct. We said by the end of 2025, maybe the first month of 2026, we are going to be in extremely euphoric markets, and before that the S&P 500 will be at all-time highs. That will be overvalued, and that's exactly the position we're at now. So it all makes sense. This is exactly what we're predicting. Other things to expect: commodities and precious metals as hedges. Gold, and remember, gold and silver are going on rallies we also expected about 2-3 years ago. We did the analysis 2-3 years ago. They are also already flashing strength, suggesting many players are buying insurance. People are getting ready for the big crash. You've seen gold go to all-time highs. Silver, yes, they hit all-time highs. They are probably going to go higher because people are getting ready for a big crash. They're buying insurance. That's what gold and silver is, especially gold. It's insurance. They're buying insurance as we speak, and you can tell by the amount. Central banks are buying insurance as well, and you can see that by the charts of gold and silver. Safe mega caps. When uncertainty increases, money can retreat towards preferred, safer mega names. That's something else you can experience as well. Cash and short-term instruments. Towards the very end, there is a rush towards liquidity, and I guess we will start seeing that in the next few months. What could pop the bubble? Because something normally pops and then the rest of the market panics and then we go into crash. And what to watch out for? Rates or yields rising. As rates go up, equity valuations come under pressure. So if we get rates going up, people will just flock to treasury bills because the rate will be so good that it doesn't make sense being part of a very risky market. If earnings disappointment or guidance, so especially in AI mega cap names, if AI underperforms this earnings season, or if the broader market underperforms in this earnings season, remember earnings season has literally just started. Main earnings season starts next week. If we start getting earnings disappointment across the board, or maybe in a couple big AI names, that could pop the bubble. Or it could be next earnings season next year. Liquidity slowdown. For example, M2 growth flattening or central bank actions. Volatility shock forcing de-risking. Margin calls, derivative unwinds. That includes the carry trade could set this all off. Or exogenous shock, geopolitical, credit event, regulatory surprise if banks start going under again. Key early warnings: divergence, small and mid caps weakening while large caps still rally, multiple compression, forward PE starts to drift downwards despite new highs, or yield inversion, bond yields rising faster than earnings yields. So that is the full analysis. That is in the newsletter today. Go back and check it out. I hope you've learnt a lot from that. And I will put this out as a video, so there will be 2 videos up here for you to have a look at. But until next time, I hope that you've enjoyed this. Make sure you subscribe and hit the like button, but take care of yourselves and each other. Okay, let me go to your comments. What does everyone think of that? Do you agree? Do you disagree? Give me your thoughts. I think we've got Martyn commenting towards first. What was Martyn's first comment? Here it was. I think setting and using stop losses is a terrible strategy. That shows you don't know what you own. Also, you don't know the value of your business. Yes, the only time I would use stop losses is if you're in a high leverage position. But in the general market, by the time your stop loss hits, is probably the point where the market might start rebounding. Um, but yeah, again, everyone manages risk differently. Martyn says, if the business is undervalued, you own it, right? The stock price is not the value of the business. So if you got the first part right, you should be buying more if it drops. Also, using stop losses was designed and was built on with one thing in mind: to make money for the brokerage that they want you to trade. Maybe Martyn's having a conversation with someone in the chat. Let's welcome everyone in, and then we'll go into the charts, and we've got some more top stories. So, Race Money is here, Brian is here, Kevin is here. Yeah, I've been holding 4 years, so been ups and downs. People said 4 years ago we'll never get to $1. When it did, they said it'll never get to 2s and 3. Yep, I think it'll go higher. What AI stocks you've been looking into? Nothing really. I'm waiting for the next leg down. David Hensley is here. Welcome in. Henrik is here. Yolanda is here. Retail is nowhere to be seen. They normally come in at the very end of a euphoric run. Stu says, anyone get some XCL tokens? Nope, I don't have any. Also, definitely not overvalued or at all-time high. Yes, as I explained, that is towards the end of the cycle, which we're approaching now. So I expect it in October, November. 100 of an ounce of silver next. Craig says, no doubt at some point pop, but how much longer and it lasts? That's the $1 million question, and I think it will be December, January, February. Is Coca-Cola safe from the crash? Nothing will be safe from a big market crash, no. David Hensley says, I hear you, man. I'm nervous as hell to around 4, but I'm a long-term holder, so I try not to look at the day-to-day price. Zed Slacker says, no stock is safe from a crash. No, not really. 4L Crypto says, good morning, Sensei. Up 28k this year. Congratulations, Stephen. Bruce is here. Angie and Bruce are wishing you a good morning, Sensei. Well, I wish you guys a good morning as well. Adam says, hi all. Let's just realize money goes to money. The rich will stay rich no matter how much I try. I'm probably still going to be struggling. Stephen B says, why are you deleting messages? I deleted not selling. I didn't delete any messages. As you can see, I've just gone through all the messages. If I deleted a message, you can see that it would say I deleted the message. Stephen B, thanks. Just need to keep it now. Ole is here. Hey, human being. David Hensley says, what did you say? Nobody erased your messages. Yes, thank you, David. Zach Zate is here. Happy Friday, all. I feel some sectors, hands down, are in a bubble. Zed Stacker, yeah. AI will be here for a long time. It definitely will be, but it doesn't mean the internet was here for a long while, but didn't mean it didn't go through the biggest crash ever in the history of the stock market. Stephen B said, I'm sad I'm not selling nothing. I've set stop losses and I'll be riding this out. Steve Mariano, oh, that's where it came from. Steve Mariano says, something huge is going on with hyperscale data. I'm not sure what it is, but something is. Thank you. William Meyer says, good morning, everyone. Zad Saka says, don't FOMO and goodbye good companies. Mike is here. Hello, Mike. Justin Wells says, let's talk XRP, people. Will it hold $2.75 support? Will it break down to $2.57 or even $2.22? Let's talk. I'm very close to selling my position on XRP. Been holding since November of 2022. I don't give any financial advice, but we might look at XRP as well. Steve says, SBC needs to have a successful flight. Once that happens, the price will go up. Jerry says, not a bubble, it's a melt up. We've read those comments. David Hensley says, I'm so mad about 79 shares of Riggy Computing with a price target of $12. I'm so mad because I didn't buy more. I bought those shares just to get into quantum computing. Well, you still made money, David Hensley, and it shows that you picked the right stock. So you understand the markets. I'm sure there'll be more opportunities. Adam said, Martyn, you're supposed to be on your holiday. You can't switch off, says Adam. Steve says, SPC will start running in Q1 2026 if they have a successful flight. David says, and before I knew it blew up, I'm up a couple 100%. Wow, congratulations. Jerry says same thing, doesn't stage. Steve B says I don't switch to Coke, then the S&P, then Coke, then bonds. I'm long term. Stop losses is to protect what I've gained this year. If the business is undervalued, you own it, right? So the stock price is not the value of the business, is what Martyn is saying. So if you got the first part right, you should be buying more when it drops, not selling. Yeah, I mean, if you bought the stock, you would want to own it cheaper as well. Where is the comments? Where were we? Um, and you don't know the value of your business. Steven says next big thing will be robotics. I've been stacking up. David Hensley says, "Oh no, we've done that." Also, using stop losses was designed to and built with one thing in mind: to make money for the brokerage. They want you to trade. Stephen B says, I agree, but I'm up so much after buying this year's dips. Martyn says that's how they make money by you trading. They don't care if it's a good, bad, or trade as long as you trade. 4L Crypto says, Sensei, look into R3 Computing. I'm not looking at that right now, but thank you. Karen is here. Stephen B says, not a troll, been following Martyn for 2 years. Martyn says, so stop losses benefit by design the brokerage, not you. Um, Yep. Mike says you need a lot of attention, don't you? Just saying and spell his name right. Another Steve is in the chat. So many Stevens in this chat today. When XRP has final moves to the upside, do you think it will pull back to $3? Yes, I do think so. Martyn says, I'm 100% out of the market with 270,000 in T-bills earning 4.5%. As the market valuation makes no sense. When we crash, which we will, I will buy with all I have. Great advice, Martyn. That's why I keep buying XRP and Quant. Martyn says, when the time comes to buy, you won't want to. That's how you know, and I will. Exactly. No one ever wants to buy the big dips. Their emotions get in front of them. Just like last time we covered the tariff crash. No one wanted to buy, but we gave you the reasons too, and Martyn went all in. History doesn't repeat itself, but it rhymes, says Martyn. Martyn also says it's not about being afraid, it's about getting on with it and doing it anyway. Justin Duke is here. Martyn says, on average, 22 times earnings never makes you any money. The S&P average is not the norm. Don't risk what you have for things you don't need. What's the point? David Hensley, thank you for the links. Martyn then goes on to say, catch a falling knife is a fallacy. If you make the most money catching a knife carefully. When everyone's buying carefree without regard for valuation, that's when you know you're in a bubble. Over the last 4 years, learning about investing, I've never learnt about investing. I've learnt about human behavior. Sick Boy Custom says, surely that 25 years ago when the dot-com crash. Oh my God, it's 25 years ago. That's crazy. Surely that 25 years ago. I can't believe it's 25 years ago. That's so weird. Surely that 25 years ago when the dot-com crash happened, why did you use that as an all-time high as a source, not taking into account the 25 years that have gone past? Just trying to work out in my mind. Because that was historically the most overvalued time. Yes, we have made new all-time highs, but that's mostly based on inflation and money being printed in the markets. The most overvalued we've been in recent history was that dot-com era. So that's the only big bubble we have to compare with today's markets, and many indicators suggest this is similar. So that chart we showed was the S&P 500 divided by M2. Let me give you this as well. Yeah, so looking at the S&P 500 divided by M2 helps investors understand how broad the stock market is value relative to the total money circulating in the economy, providing insights into potential inflation, future economic activity, and market trends that simpler analysts miss. And expanding M2 can signal potential growth for inflation, while shrinking M2 can suggest investors are moving to safer assets. So essentially the money supply, which we're dividing the S&P by, is a broad measure of the money circulating in the economy, including cash, checking accounts, saving accounts, money accounts, and certification of deposits. So we are looking about how much money is in the system and how much of it is in the S&P 500. The last time we've ever been at this valuation of the amount of money in the world in the S&P 500, you can look at it that way, was in 2000. And that's the chart over here. So you can that's why this chart does not show an all-time high, because we're not at an all-time high of the S&P 500 divided by the amount of money printed. And again, a lot of money was printed between 2000 and where we are today. So you can see we are getting close to all-time highs on this specific chart. But of course, the S&P 500 itself has made new all-time highs, but not compared to how much money is actually in the system. It's a very, very important chart to keep an eye on. Where were we? So I hope that answered your question. Sick Boy Customs. Crypto Buyer says David Hensley, best quantum computing company is D-Wave. We had a look at that yesterday, I think. Martyn says, how I make money is not focusing on winning. I'm focusing on not losing. That's also very, very important. Money is on the side ready to buy, says Thomas Morrow. Beans on Toast says, have you looked at the corporate bonds as well, Martyn? They're 5% corporate bonds, ETF. Yeah, that corporate bonds, but they're a little bit more risky. A little bit more risky than the Treasury. Well, a lot more risky, but still very, very, very safe, depending on the rating. But yeah, they can give you returns of anywhere between 5-10%, even more. Martyn says, you always have more and rise to top if you constantly win rather than win big and lose big. Donda says, what is your predicted timeline for gold throughout the crash? I don't know what predicted timeline for gold throughout the crash. Predicted timeline for gold throughout the crash. I don't know what you mean by that. Martyn says, simple but not easy. I can tell you what to do, but most of you won't do it. Raymond says, and he does, and of course we don't give advice. Raymond Zapta says, and the Trump wildcard could actually permacut government programs, employers. Best to sit this one out. Yeah, Trump is certainly making this a much more uncertain market. I mean, whether you like Trump or you don't like Trump, everyone can agree that the markets are a lot more uncertain. I mean, look at gold. Gold wouldn't be up this much, but all banks around the world wouldn't be buying gold if everything was more certain today than it was before Trump got in office. Raymond, if you look at the stock market during Biden, it just incrementally, just slowly went up, and we had one of the best markets ever. Just slowly went up. Ever since Trump came in, volatility, and now we're in a bubble, and now we're expecting a crash. Stephen Owen says, thanks for answering my question. I will sell everything I bought for around $3 worth of XRP and take profits back and buy in at $3. Beans on Toast says, you didn't like my treasury and bonds when I told you about the Martyn. Yolanda says, as Martyn always says, it's easy to make money, but it's hard to keep it. I get it now. Thanks for the advice. Yes, that's one of the biggest bits of advice. Brian says, oh, Kawaim is here. Good morning. Brian says, but we're looking at all of this with the wrong eyes, past eyes. Surely the financial world is different now. Just a question. Yeah, the financial world is very, very different. You're completely right. But human sentiment is not different. Human sentiment won't change. We'll go into a bubble, we'll crash, and then we'll continue higher, in my opinion. A bubble can't last forever, even however great the technology is. I might be wrong. Patrick says, what do you think of XL? I haven't looked at it. Vinman Sensei is a crypto that involves a big problem with good hedge if a crash occurs. Sensei, is a crypto that solves a big problem with good hedge? No crypto will be a good hedge if a crash occurs. Absolutely not. The best cryptocurrency in the world won't be a good hedge. It'll be good to buy on the crash, but not during the crash. It will crash more than the general market. Sick Boy Custom says, thank you, Sensei. I understand now. Appreciate it totally. No worries, Sick Boy Customs. Justin Duke says, got 100 shares of Apple right before it beat on earnings. Got any thoughts on how high it could go? We can, if you do a chart request for $4.99, we can have a look at it. Martyn says, I'm done. I hope that helps. Best of luck all. Thank you, Martyn. Sean June says, .com companies had no income. That's not the case now. Markets were just profit taking. Yeah, I'm not expecting the same level of crash compared to the dot-com bubble. I'm not expecting thank you for noting that. Yeah, I'm not expecting the same level of crash. So if you're looking at the dot-com, and I'm not expecting the same level of bear market, because as you said, these AI companies are actually making money. They might be overvalued. We don't know what the future looks like 2-3 years down the line with AI, but they are making money. So that is a big distinguish. Some of the dot-com stocks were making money, but you'd have to look into the future. Anyway, it is different. I'm not expecting the same level of crash. If you look at, I mean, look at this chart first of all. We are this far away from, look at this chart. Just look at the screen for a second. You won't be able to see it very clearly, but you can see this. Down here was the dot-com bubble. We are now all the way up here. We are thousands of percent higher than we were in the dot-com bubble. But if you divide it by how much money has actually been printed in the system, we are still not at the level that we were in 2000. It's a completely different chart. You can see how clear this chart is. And this chart has saved me many, many times. Remember when we had the breakout back in May of 2023 out of the bear market? We said we're going to go on a big run. Remember that tariff crash as well? We came and tested that exact zone. We came and tested it. So this chart's been great, but you can see we're not even at all-time highs on this chart. But if you look at the S&P 500, we're so far away from that dot-com era. It's just because there's not as much all the money that's in the system is not being invested in the S&P 500. We're actually very close now, but throughout this time we weren't. Anyway, back to the original question. The dot-com bubble. The question was, the dot-com bubble, no one was making money. It's very different now. I agree, it is different. But we are still in a bubble with all the indicators we've looked at. Even with all the earnings. Remember, all of those indicators we looked at all included the price to earnings. So we were taking into account the earnings. And we were comparing it to the dot-com bubble. So it's not entirely true, the statement. But we are taking into account the earnings. But secondly, I'm not expecting the same level of crash. In the dot-com era, we got a 50% crash. Then we got a 100% move towards the upside. Then we got another 50% crash. Then we got another 100% move to the upside before we actually broke out. So we actually went sideways from the top, and we never made all-time highs for about 400. How many years is that? 4,748. So what's that divided by 365? 4748 divided by 365. We went sideways in the market for 13. Oh yeah, well, it was 2013. 13 years we went sideways and we didn't make new all-time highs. That's the difference of the dot-com. So I'm not expecting not to make all-time highs for 13 years. I'm not expecting to go sideways for 13 years, but I am expecting potentially a 50% crash. But remember, it took 13 years to grow into those dot-com valuations. Obviously, we also had the 2008 crash, which put a dent in it all. But even take away the 2008 crash, even to get back to those same levels, if you think the 2008 crash affected it all, which is a valid point, it still took 7 years to go back to all-time highs. 7 years, and then we crashed 2008, and then another, basically another 8 years. So the dot-com took 7 years to recover, and potentially another 6 years. I don't expect the same. So there is a difference. The dot-com era, I do think, was built on a lot less fair valuations. I think there was a lot of terrible companies. AI this time around, it's showing that it can grow into those valuations. So thank you for bringing that up, and I hope I answered that for you. Thoughts on Zcash? I don't have any. Beans or toast, love the name. Good, learning is the most important thing. Martyn, you are welcome. Human Being says, thank you, Martyn. Hugs to you both. David Hensley, thank you very much. 10-year yields was a gift at 4.187%. Ole is here. Adam says, how nice is it where we all are talking to each other from all corners of the world? Such a great channel. Yes, Adam, that's what we love so much about this channel. Thank you. Sean June says, SBCE price level chart predictions near term, please. If you do a $5 super chat, we can have a look at it. Ian Paul says, could it maybe also be that there's more money in stocks because the youth just doesn't um, have another financial future perspective than investing in stocks? It's impossible to get a mortgage nowadays. In 2000, there was more people investing in the markets than there, or more of the money in the world was invested in the markets. Bizan says, but it's a good point. Thanks for bringing it up. Backzan says, is XRP safer than most in 30 days hold? Is XRP safer than most in it? Is XRP safer than most in a 30 days hold? Most crypto, Bitcoin's probably the safest. Yeah, it's a top 10 token, so it's probably going to be one of the safer ones crypto wise. Yeah. Phil says, got a 1 ounce silver coin that has cold wallet built. I've got a 1 ounce silver coin that has a cold wallet built in with 100% 100 XRP preloaded to it. How did you get that, Phil? That sounds very cool and interesting. Beans on Toast says, all the youth in Sweden own coins, therefore I'm not in crypto. David Hensley says, at crypto, thanks for the tip. I will definitely look at D-Wave. Steve says, Zora has been parabolic pumping right now. Justin Duke says 200 plus people. Let's get this live stream up to 200 likes. Yes, thank you, Justin Duke. If you haven't hit the like button yet, please do hit the like button. Subscribe if you haven't done so already. What's your prediction for HBAR? Do you see XRP separating from the rest of the market in the future? What's your price prediction for HBAR? You can do a chart request. I don't know off the top of my head. MC Cafe says, what do you make of NBIS? I haven't heard of it. Again, if you want me to have a look at it, you can do a $5 super chat. David Hensley says, yes, it's very cool how we can come together like this. It's the best channel in the world. Martyn says, Mike says, look at the pics in general Discord. General chit chat. Let's have a look. Thank you, Mike. Let's have a look. General chit chat. Where are we? Is it general chit chat? Yeah. Mike says the fourth monkey has. Oh, I can't put it. Let me put it here. The fourth monkey has emerged. He sees no one, hears no one, and speaks to no one. All right. Thank you for that, Mike. I'm sure a lot of people can relate to that. Was there anything else? Sensei's rooster when he makes a great trade. Oh, I love it. Thank you very much, Mike. Oh, this was the other day. This was when a ladybug crawled on my screen. Have a look at this. This is funny. I've got something crawling on the screen. I think you guys just saw that go past. That was funny. Look at that on my screen. I've got something crawling on the screen. I think you guys just saw that go. Who did that? I remember someone super chat. It was Nick Jones. That was funny as well. Thank you very much, Mike. I think I've gone through it. Let me go over here. There we go. General chit chat. Is SBC going to $100 per Martyn? Your thoughts, please. I think it can do. Yeah. Good morning, guys. Bring luck. Yeah, I mean, if everything goes well, SBC can easily go to $100. Not easily, but it can do. Oh, what have I done? Okay. So, that's my thoughts anyway, and that's why I think. I mean, it's what we've been saying for the longest time. We're going to go into a euphoric period. The crypto bull run runs on euphoria. That money starts getting into a bubble, and then the final part of the bubble is the most explosive, not for the major caps or the safe investments, but for those high risk investments. And that's what we're waiting for now. Here in October, I do think by the end of October, we're waiting for the shutdown to end, ETFs to get approved, because remember, the ETFs now get approved after the shutdown ends, which I expect to happen next week, shutdown ending, so the ETFs will probably get approved when we were expecting them to anyway, which is the week after next. If the shutdown goes on for too long, that could be one of the triggers that pops the bubble, if it lasts for more than like 6-7 weeks, because no one would expect that. And there'll be a lot of pain in the market if that happens, so that could trigger the bubble burst, and that could be premature. So I'm not saying we're gonna 100% have a bull market in crypto, but I'm very, very confident we will. And the risk to reward, if we do, is worth me staying in because I'm a high risk investor. Other stories today was the pound tanks on physical fears. Sterling heads for the worst week since January, sliding on tax hike worries and sticky inflation. Klarna CEO sounds the AI alarm. AI will hit white collar jobs hard, warns Klarna chief. Cost cuts now meet economic disruption risk. The Senate tightens chip exports to China. US passes a law giving Nvidia buyers a at-home priority, shaking up global AI chip trade route. The SEC unblocks IPOs amid shutdown. Emergency SEC rule lets IPOs proceed without review, risking post-listing scrutiny for disclosures and pricing. The EU buys Russian energy despite Ukraine's stance. European nations ramp Russian imports, clashing with pro-Ukrainian stance and exposing firms to backlash risk. Are we nearing the top? Valuation metrics scream late cycle, stretch price to earnings, weak breadth, and thin yield gaps hint at looming risk. The SEC is letting IPOs proceed without full review during the government shutdown. Companies like BitGo and Navan can now list using a 20-day auto approval rule. It keeps markets moving but shifts risk to after the bell rings. The fast-tracked IPO means higher post-listing risk. Before jumping in, check cash flow, revenue, and sector strength. Hype fades, fundamentals don't. So we've got a new rule there from the SEC. A quick look at the markets. We're looking at silver now up 2% today after its big rally yesterday, and then it obviously sold off after making new all-time highs as expected, but it's looking to break $50 once again, and it has just broken $50 once again. My main target on silver in the next maybe few months is $73. Gold is also now up on the day after selling off tomorrow 1.6%. It's looking to regain those losses. What else are we looking at? The S&P 500 is now actually up even more this morning, up 0.18% after a red day yesterday. Yesterday, everything did come down. What else do we have? We're looking at the crypto markets. What's going on? Oh, we've got a lot of altcoins now in the green today. Recovery, SNX is up 13%. We've got Litecoin up 4%. We've got Flare up 1.4%. Bitcoin lagging behind today. Bitcoin down while the rest of the market's up. Where is XRP? XRP only up 0.6% as well. We are hoping to either get a triple bottom at $2.70 or a higher low on XRP. I mean, the worst case scenario, in my opinion, or a main level that I wouldn't if we get below $2.62, then I get concerned, but going down to $2.62, I would see that as a nice entry point. But holding 274 would be a bit better for XRP. Let me just have another look at the stock market. Is there anything moving there? Tilray closed up 22% yesterday. Remember, we looked at this at 44 cents, now up at 2.31, pre-market at $2. Wrap Technologies was up 4% yesterday. Etsy was up 3.8%. Meta up 2%. Nvidia making new all-time highs yesterday. Hits our target. Our second to last target on Nvidia was hit, $194. Again, Nvidia is really hitting some major targets, approaching $5 trillion. Robinhood up 1%. Lyft down 6%. Vivo Power down 4%. What's moving this morning? Rocket Lab up 5% this morning. Remember, we bought Rocket Lab at $4. It's currently trading at $70. All-time highs on Rocket Lab this morning. Mobix up 2%. SoundHound up 2% pre-market as well. Let's tune into Bloomberg, see if there's anything going on.
United opening up a route to Bari or Bilboa in Spain or Italy. I think that, that ignites demand that wasn't necessarily there. That's a route that nobody flies directly from the U.S., and it could, instigate demand. Last year they did Greenland, so this year they stuck a little bit more conservative with their routes.
Sheila Kahyaoglu of Jefferies, thank you so much for being here. Really interesting point there that Sheila made, Anne-Marie, about the international travel for Delta and this question of whether it's tariffs, whether it's other issues, the international inbound class. That's the one area of weakness that you are seeing.
And the issue with tariffs, if you were looking to potentially not take that trip, not buy that car, well, once you have certainty, you're willing to maybe buy the car. But are you going to go take the trip now that it's October and it's a little bit cold, when you were maybe planning on doing a summer holiday in Europe? No. So maybe you just say, I'll go next year. You can't make up for some of that lost demand.
Meanwhile, what you are seeing in markets is something of a rally that is building on the heels of these comments from Fed Governor Chris Waller, where he did say the job market was a bigger concern than any kind of inflationary pressure, saying that payrolls was likely negative. This in an interview this morning. That's giving a real boost to what we're seeing in the bond market, and then giving a boost. The Russell 2000 futures up 0.4% now, Anne-Marie, really outperforming on the heels of the rally in the bond space.
Look at that. So we've got Fed Waller coming out saying jobs market is more of a risk, which we have been saying for a long time. But also, this is exactly what we've been talking about today. The S&P is up 0.15%, but look at the Russell 2000. The money is going into high risk, up 0.41% today. So we'll see that all unfold, and we'll see if we're right, we'll see if we're wrong. Time will tell. Let's see where we are in 3 months' time. But my prediction is we'll continue on a face-ripping rally until the bubble bursts, and then we go into quite a sharp downturn. Maybe we have a downturn and then a relief rally. Maybe a dead cat bounce, go into a bit more of a recession at some point halfway through 2026, and then look for recovery in 2027, and then going into the next bull market of 29. Anyway, that is my thoughts and opinions. I hope you enjoyed it. There is a lot more news in the newsletter this morning, so do go and check out the newsletter today. Lots of news in there. I'll give you the link for the newsletter. We won't be live tomorrow because it is a Saturday. There might be a video coming out later today. So if you do see it, please do watch it all the way through. There is the link for the newsletter. Keep an eye out for any videos coming out. We might be live later with that. We might not. Again, I'll continue doing my morning shows at the exact same time every single trading day, but apart from that, you have to keep your notifications on so you can know when we go live. Let me go and have a final look at your comments before we end today's show. Good morning, guys. Hello, Ninja Cowboy. Rewind the stream. We did a very important analysis the first 20-30 minutes of the stream. Yeah, if anyone's just tuned in now, we gave you 4 indicators and I gave you all my thoughts on this. One of the most important deep dives we've done about the market and where we are. So rewind to the beginning. It's about the first 20 minutes you have to watch. No payrolls for today. What do you think about FXRP? I like the premise of it. I like what it's doing. I like the demand it's created for XRP, but right now I'm not interested in minting any myself or using it. But it's a bullish thing for XRP. So thank you everyone for tuning in. Make sure you keep an eye out for the channel. I'll be back on Sunday with the Electrum member event. So if you're not an Electrum member yet, please make sure you do upgrade so you can join us on that exclusive Sunday show. Until next time. Oh, thank you, Victor. You have a nice day too. Everyone have an amazing day, nice weekend. I'll see you back for the Electrum event if you don't see me in a video beforehand. But until next time, take care of yourselves and each other. We're going to the extra channel next so you can continue the conversation going. Until next time, take care of yourselves and each other. Bye-bye.